The beauty of the fund launch formula, it helps you vet out your ideas to know if you're building an investment product that investors want. That's why people always complain, like these fund managers are making all this money and they pay little taxes. Well, the IRS has incentivized fund managers. What type of investors are you gonna raise from? How are you gonna incentivize those investors? Say everything checks out. Can I put you down for a verbal commitment of $100,000? So when launching a fund, we've actually seen repeatable formulas that have created very successful fund managers. And I will say I more discovered this rather than invented this. And we've teamed this or called this the fund launch formula. So I got the great chance of interviewing and talking to very successful fund managers through our company Fund Launch. I got to meet with dozens and now hundreds of different fund managers, and I asked them similar questions. How did you launch? What was the process? Walk me through it. And a lot of them gave me the same repeatable steps that they used to launch their funds. And which was funny enough, it's almost the exact opposite of what you would maybe read online from a blog post or a YouTube video on how to launch a fund. Because when most people tell you to launch a fund, the first thing they say is, okay, step one, go hire a lawyer. Step one, go find a lawyer. They're going to set things up for you and go from there. And I was going, hold on. When I talked to these hundreds of fund managers, they didn't do that. They followed a different process. So we finally coined this and deemed this what we call the fund launch formula. This is a 4-step formula that puts together a process and a step-by-step guide to launch your fund. I'll give away number 4. Number 4 is actually legal. Okay, so they actually put the legal part, hiring the lawyers, at the end as your last step. So then, Bridger, what is step 1? So step 1 that we found was most people start with the deal or the thesis. The idea that you find a great deal. When, again, starting your first time fund, when you have a great deal or investment philosophy where you found asymmetrical risk versus return, it could be, hey, we're gonna go buy these restaurants. It could be, we're gonna buy car washes. We're gonna go invest in the futures market with this new strategy, with this AI tool that's incredible. And we've backdated it and stress tested it and got it all amazing. Again, most people get so excited, they go, okay, I'm gonna go hire a lawyer. And I go, again, that's step 4. So we found a great deal. Step number 2 is how do we frame out the fund? How are we gonna put the fund structure together? How are you gonna run your waterfall structures? What licenses do you need? Are you gonna run an international feeder fund structure? What type of investors are you gonna raise from? How are you gonna incentivize those investors? And we drive all that down into usually a pitch deck that shows off your edge for your fund. And what most of these successful fund managers did before they went to legal is they actually took that pitch deck, and step number 3 is go and pitch investors. So they went and found investors that are already in the space. Maybe it's a mentor, a coach in your field, and said, hey, do you have 11 minutes? I want to launch a new fund. Can I practice pitching on you? I want you to poke holes in this, rip this thing apart. Tell me if it's good or bad. Does that sound good? Most people, if they're someone you know or a mentor in your space, they'll say, yeah, I got 11 minutes, let's do it. So you hop on Zoom or a call or meet in person and say, okay, here we go. Here's my run through. Here's my deal. Here's my thesis. Here's my ideas. And you run through the whole thing with them. And one of 2 things will happen. They're gonna say, I love it. I'm gonna give you millions of dollars. I'm in. Or they're gonna poke holes. And more likely, they're gonna poke holes and say, hey, did you think about this? Did you try this out? And what'll happen is that's step 3. You're gonna go back to step number 1 and step number 2 and tweak your deal, tweak your offering, how you're structuring your fund. And then you're gonna say, hey, all right, Mr. and Mrs. Investor, I'm gonna come back in 3 weeks. I'm gonna fix some of these tweaks, and can I pitch you again? And maybe they'll say yes, maybe they won't, but you find more people and you keep doing this process of step 1, having that great thesis and deal, number 2, framing it out, and 3, pitching investors. When I help someone, we do this. We've now launched 210 funds through Fund Launch in the last 2.5 years. What we try to get someone to do is by step 3, to get verbal commitments from somebody. So what you'd say is, hey, okay, we've ran through the deal, and they actually say, you know what, I kind of like it. You've done a really good job. You've structured the right way. I like this. And you say, hey, the legal docs are not done yet. But if I put this together, I plan to do it, could I put you down for, and let's say everything checks out, can I put you down for a verbal commitment of $100,000? Non-binding, I just want to know your interest. And again, they'll tell you, you know what, yeah, I'm in, or I'm hesitant. And you say, well, why are you hesitant? Well, I don't love your team, or I don't love your strategy. They'll actually give you the feedback. We try to get each person in our group about $2.5 million verbally committed before we go to legal, which is step number 4. And then when you go to step 4, you walk into a lawyer's office and you know exactly the fund you want. because you've already structured it. You've done the iteration process. Lawyers are great for building legal documents. They're sometimes great at doing strategy, usually not. Well, in my experience, and I'll tell you both stories. I had a friend, he did not follow this formula. He went straight to lawyers. And he walked in and lawyers sat down with him and they said, okay, he's like, I want to do a fund. We're going to buy these restaurants, do this cool thing. He said, great, let's do it. And they go, well, do you want to run an American or European waterfall? He goes, what does that mean? And the lawyer proceeded to explain what an American versus European waterfall was. And it took him the next 35 minutes. Hey, do you want to run a Reg D 506B or a 506C fund? Do you want to do a 3C1, a 3C5, a 3C7 fund? He goes, I don't know what that means. And they then proceeded to explain. He's billing $1,000 an hour, this lawyer. You don't want your lawyer to also be your teacher because that's a very expensive teacher to have. When I walk into a lawyer's office, I've done step 1, 2, and 3. I walk in, I say, hey, I want XYZ with a drink and a side of fries. Like, I know exactly what I want. Can you just build this for me? They say, great, we'd love to. And bam, they build it out. My docs are done in 2 or 3 weeks. We have a fund. And more importantly, we have a fund that investors want. I have another friend. He actually knows funds very well. Went to a lawyer, built this beautiful fund, spent $50,000, $60,000 on fund documents. He took it to his investors and they hated it. And they said, well, let's tweak this and change this. He said, hey, lawyers, can you tweak it? They went back and forth with the lawyers tweaking his documents. He spent on his first fund, he told me, over $500,000 on legal docs on his first fund. He goes, it should have cost me $40,000. It cost me over $500,000 because I kept tweaking and changing my documents because I was doing this fund launch formula backwards, if that makes any sense. So I think there's so much validity in doing step 1, 2, and then 3. So during COVID, we wanted to go buy these big box stores. And we thought we could turn them into self-storage centers. So we'd convert like an old mall into self-storage. We'd maybe put some office space in there. We'd have a better and higher use than a mall that is empty during COVID. And maybe we could get really good deals. So we thought this was a cool idea. We got a cool real estate team together. We built out this deal. We found a great deal that we were looking at. We framed it out. We took it to investors. And investors just didn't like it. And we were like, no, look at the future. And they're like, I don't know if I see it yet. And then we went back to the drawing board. We tried again. And investors just didn't bite. They just didn't like it. And over about 3 months, we just said, hey, maybe this just isn't the right plan right now. And then we started to come out of COVID. Retail came back raging. We said, wow, well, thank goodness we didn't buy these assets and convert them because we were coming out of COVID. And thankfully, we didn't launch that fund because we did step 1, we found great deals. Step 2, we framed it out. And step 3, our potential investors didn't like the deal. I spent $0 on that. All I wasted was a little bit of time. If I would have gone the other route, I would have been $50,000 deep in legal fees to never launch a fund. The beauty of the fund launch formula, going in that order, step 1, 2, and 3 specifically, it helps you vet out your ideas to know if you're building an investment product that investors want. We then pivoted. I found a great team. I love the blockchain crypto market. I thought that was so interesting. We said, what if we built a long-term risk mitigated fund in cryptocurrency? I know people want to be in crypto, but they don't want to have the crazy volatility. What if we just played the long-term game of crypto and built a base of goods? We just played the long game. We got yield returns, etc. We built out a test portfolio. We took it to investors. Investors loved it. We raised roughly $10 million in our initial launch. We built docs. It took us a couple weeks to build docs. We launched, and now we're over $25 million in assets that we manage because we followed the fund launch formula. I'm so grateful we didn't launch that other fund in big box stores and do that. So I think it's the beauty of the fund launch formula, to build a fund that people want. So what are some of the biggest mistakes first-time fund managers make? Now, I'll speak from my experience. Somebody else will probably tell you totally different. The first thing I will say is most funds never launch. They have so many things in their brain of all the things they need to get done first, or money or whatever. They actually never launch, and they would have been great funds. Statistically, emerging fund managers actually outperform large fund managers on a return basis. Statistically, across the board, smaller funds have better performance than larger funds. Why? Usually they're more nimble, they're more closer to the deal. It's a lot easier to deploy smaller amounts of capital than multi-billions of dollars of capital. And so smaller fund managers actually tend to outperform. And there's a lot of amazing funds that never launch because they don't follow maybe the fund launch formula, the sustainable process. Now, back to the question of, at least my opinion, the biggest mistakes most first-time fund managers make. Number one, they don't think in long-term scope. And hopefully I'm trying to do this, but the idea of, I'm going to play this game for the next 50 years. Some people get in their brain, I'm playing this game for 18 months or 6 months or 8 months. I got to get a return right now. And they're so long that they take unnecessary risk, in my opinion. If you have the approach of, I'm okay with making less money now, giving more money to my investors and playing the long-term game, and looking at like a Warren Buffett or a Ray Dalio or a Ken Griffin who've played this game for 30, 40, 50, 60, 70 years and allowing themselves to compound. And to compound meaning you give investors great returns consistently. You are risk mitigated over a long period of time. You can do extremely well. I've seen some people, and even myself included in that mix, to not play the long-term game. And so the way I think about funds are not a get-rich-quick scheme at all. But funds can get you very rich. One of the wealthiest people on earth rich if you play it well over a long period of time. So how did I build my first strong investment team? Well, I'll say on my first little debt fund, it was just me. I was the team of one, and maybe a little naive, a little good, but we ended up doing well, and because we were so close to the business. On our next two funds with our crypto hedge fund, I went out and found people that were incredible in blockchain, that had done this through multiple market cycles. Crypto is a relatively new asset class, so I wanted to make sure they backdated and tested performance for years. And I believe we've got a very, very solid team. On our fund launch partners or GP Stakes fund, that I'm a partner on as well, that team, we've taken a much different approach. We've brought in different people with different thoughts and opinions on markets and or people. Again, we're doing a GP Stakes fund, so it's a lot of times we're investing in people. In a blockchain fund, you're investing in markets, which again, we're doing that in the GP Stakes, but in GP Stakes, we're betting more on successful fund managers that we're gonna work with. So we need people that can read people in a different way, that can do due diligence on somebody in a better way. But in my opinion, the best investors I've seen of all time, and I'm trying to become better at this, is the people who can ask the best questions. And I've really thought about this a long time. The difference between me and you and the best investor in the world is just the quality of questions we ask. If you look at a Shark Tank committee or an whatever investment committee, the quality of that committee is really based on how good of questions do they ask about a person, a market, a trade, a long, a short, whatever it is. What are the quality of questions they ask? And if you can train yourself to ask better questions, you tend to minimize risk more and find more alpha in markets. And a lot of times we will miss on a deal or have a bad trade because we didn't ask enough appropriate questions about that underlying asset or underlying person to get enough data on them. In investing, we talk about two different terms a lot, alpha and beta. Now, in simple terms, beta is your measure of volatility against a market. So for example, a lot of funds will measure against the S&P 500. So your beta would be that coefficient. Your alpha would be the difference between that beta mark and your excess return above that benchmark performance. So now a lot of times people will throw around the term alpha as just, this is our expert analysis or whatever gives us alpha or an advantage on the certain market or gives us that excess return, if that makes any sense. So most funds, again, are trying to beat some kind of benchmark like the S&P 500. Because our fund does AI trading or whatever, that gives us alpha that is going to beat the S&P 500, our beta mark, over the course of 10 years. That would be the technical and I guess loose definitions of alpha and beta that people throw around. So there's a couple ways that I know if I have true alpha when I'm running a fund. The way I look at it is, again, back to risk control return. So what are my risks that I have that I can and can't control, and how do I minimize those risks? If I can lower the amount of risk and I can keep my return or maybe even increase my return, I can drive alpha in a business. There's a theory out there called the efficient market theory. The efficient market theory says this, that essentially everything in the market, every piece of knowledge is already priced into the market. That markets are extremely efficient, that there's traders and trading bots out there, that the moment a news article comes out about Tesla or Amazon, the markets instantly adjust and it's very efficient. Now, this is a great claim for markets that are very liquid and have lots of volume in them. Yes, they are very efficient. However, there are many inefficiencies in markets, and especially as the further you get away from liquidity, the more inefficiencies you can find. So for example, real estate is a relatively illiquid market. Hence, you can find a lot of times a lot more inefficiencies in certain markets, which in turn can drive you alpha for those investments. House flipping is the best example. You've all seen the TV shows where someone finds a house, it's run down. The alpha they bring is their expertise on, man, we could repaint that wall and put some carpet in for a couple $1,000, and then we can put this house back on the market and sell it for another $100,000 more than we bought it for. They, because of their expertise, hiring a few people, putting some time into a project, they created $100,000 of alpha on a product like real estate. The same thing is true with private equity or buying businesses. Businesses are a relatively illiquid market. So you can come in and say, hey, just like a house flip, here's a business that's running poorly. What if we added a new sales team and a new marketing structure and a new branding? Could we take the value from here to here and create alpha on top of that? And this is why alternative assets have done extremely well over the course of any kind of study you look at, looking at alternative investments, things that are alternative to maybe stocks and bonds, have generally over time drastically outperformed the regular market. And the reason is alternative investors, people that typically are running investment funds you deem as alternative investments, have done an incredible job at finding inefficiencies in markets and making them more efficient and finding alpha on top of those. So what is your unique edge in your fund and how do you drive down to your edge? So after helping now hundreds of people go out and launch funds, we've identified a few areas where each fund has a unique edge when they're doing this. And we've broken this up into 4 specific categories of an edge. And I kind of look at it as a wheel or a circle. The first one I look at that they can drive, again, an edge. And some funds will lean into some pieces of this more than others. So for example, one of the edge pieces is your team, the expertise of your team. If you came to me and said, Bridger, I have Elon Musk, Jeff Bezos, Ken Griffin, Jamie Dimon, we're going to invest in this brand new thing. You don't even have to tell me about the asset class or strategy. I'm kind of sold. I mean, that sounds pretty good because the team is so strong. You got some of the smartest people on earth. Like, I'm in. I don't even care what the other pieces are. And that would be a stronger piece of your pie chart than others. So again, the 4 categories are, though, your asset class, your strategy, your team, and your structure. Those would be the 4 pieces that would make up an edge. And hopefully you can strengthen all 4, but some funds will lean into one rather than the other. So let's start with the first one, asset class. Your asset class is a part of your edge. Now, depending on which type of investor you're talking to, this will change drastically. If you're talking to an institutional investor, most institutional investors have already chosen the asset classes that they want to get into. Meaning they'll say, hey, we've already decided we want to allocate 21% of our investment portfolio of $100 billion to commercial real estate. We want to devote 11% to private equity. They've decided the asset classes. Additionally, they will pick emerging asset classes. So for example, a recent hot asset class is artificial intelligence. Just by saying, hey, our fund goes after artificial intelligence, that asset class, that might give you an edge over somebody else that says, hey, we're investing into I don't know what's Beanie Baby companies, or we're investing into sewing machine companies, right? Sewing machines are kind of old school or maybe dead a little bit. AI is new, and that asset class will either give you or hurt your edge. That's number 1. So number 2 is the strategy you approach that asset class with. So hey, our asset class is AI, artificial intelligence, very strong. Our strategy is we're just going to go invest into AI companies and we're a venture capital firm. We're just going to invest into 50 of them and we hope one of them does well. So I would call that a relatively weak strategy, but a strong asset class, an investor still might say yes. A different fund might come to you and say, hey, we're investing in some crazy derivative market off of the futures on whatever, some crazy asset class you've never heard of. And you're like, I don't even know that asset class, but our strategy is we have this incredible trading formula. We've done this for 25 years. We've crushed it. And we have this incredible strategy that we take to derivative markets on Forex or commodities, whatever the thing is, and we make a great return. We've done it for the last 25 years. It's like, wow, okay. I don't even care what the asset class is, but this strategy sounds really cool. I'm in on that. Does that make sense? How that would be a bigger one than this first. So again, to review, asset class, strategy, team, and structure. We've already gone through asset class and strategy. The third is team. So team, again, who is your team? I mentioned before, if you had Jamie Dimon or Elon Musk, that would strengthen your team. That's pretty obvious. The fourth one is structure. How are you actually structuring your offering? For example, one of my edges on my first fund was I said, I am not going to charge you a management fee. So I'm going to charge you a 0% management fee, part of my structure. And I use that as a compelling part of my pitch, saying I won't make money unless you make money. I only make money on performance fees. You have to get at least a 10% rate before I start making money. And it de-risks the investors. I've seen some funds that have wonky strategies. They're like, hey, we're going to charge you 5% fees and 30% over here and something different. And it hurts their edge because the strategy is kind of wonky. On the other side, one of my dad's first funds, they would charge 0% management fees. And the first 16% of all returns would go to the investor. So they literally said, we make $0 until you've made at least 16. So you got to you make the first 16. And then after that, we'll start splitting. I think it was like 50-50 or 80-20 or something like that. So as an investor, you're like, wow, man, they don't make any money, no fees, no nothing unless I make 16. That sounds like a pretty good structure. And it played into their edge. So again, when building out your edge or your strategic advantage in your fund, you can lean into these categories. Number 1, asset class. Number 2, strategy. Number 3, team. And number 4, structure. Now, hopefully, your fund, all 4 of them are very strong. Maybe in your first fund, you're going to lean on one of them more than another. And over time, that might evolve into something different. But those are the 4 key categories to think about when building out your strategy or edge inside of your fund. So how do fund managers actually make money and get paid? So there's 2 different types of ways most fund managers get paid. Number 1 is management fees. And number 2 is performance fees. That's most common. So you'll hear something like a 2 and 20 fund. What that means is a 2% management fee per year and 20% of what they call carried interest or performance fees. So to run a little bit of math, if you had a $100 fund, $100, 100, you took a 2% management fee per year, that would be $2 per year that would come to you. Whether the fund does good or bad, that's a 2% management fee that comes to the fund manager. Additionally, let's say in the year we went from $100 to $110 after fees. So we took the 2% management fee after fees, we went from $100 to $110. We would split those returns 80-20. So 80% would go to the investor, so $8 would go to the investors, and $2 would come to me as the fund manager. That'd be a very simple, basic structure for how fund managers are paid. Now, to go a next step further on payments and payment structures, there's a few different terms that you can use and ways that people organize and are creative about these structures. A lot of funds will use a few things. So let's use an example of maybe 0 to 20%, okay, on a scale. A lot of funds will say, hey, we're going to do an 8% pref or preferential rate of return. So what that means is the first 8% goes to the investor, goes to you. So if this year we make 7%, all 7% would go to you. So again, 8% preferential rate of return all goes to you. Once we get above 8%, some funds will do what's called a catch-up. In my first one, we did a 2% catch-up. So the 9th and 10th percentile would come to me as the fund manager to catch me up. And then what we said was above a 10% return, we'll split 80-20. And that would be our carried interest or our carry. So again, if we got, let's say this year, a 20% return this year after fees, the first 8% would go to the investor. The next 2% would come to me, the 9th, 10th percentile. From 10 to 20, we would split 80-20. So 8 points would go to you, the investor, and 2 points would come to me. So if you total that up, we got a 20% return of after fees. The original 8 would go to you, plus another 8. The investor would get 16. Me as the fund manager, I would take 4 points. So for a total of 20 after fees. But additionally, I got 2% for management fees, so that's about 6% that I get on that structure. Now, you might be sitting there like, well, Bridger, I don't want to make 6%. That sounds so small. No, yes, you do. Okay, this is what's created some of the wealthiest people on planet Earth. So to put this in math, instead of $100, imagine it's $100 million. And this year, after fees, after taking out the 2% management fee, we ended with $120 million net of fees. That would mean your investors would take home $16 million and you would take home $4 million, right? But again, you add that 4 million plus the 2 million of management fees. It was 120 million after fees. So you would take home $6 million. Your investors took home $16 million, or a 16% return on that year net rate of return. So $6 million, that's not too bad. And that's every year. Okay, that's about $500,000 a month on a $100 million fund. The cool thing about funds is it scales just like that. A lot of times funds, as they grow, you don't need to hire more employees. You can just add zeros. So if you ran a $1 billion fund, that's $60 million a year you and your team makes. That's over $1 million a week. If you run a $10 billion fund, that's $600 million a year that you and your team makes. If you're like Ken Griffin and you run Citadel, Ken Griffin made over $4 billion last year running his fund. Personally, that means he's making over $1 billion a quarter. And that's not like net worth. It's not net worth is going like Elon Musk, his net worth goes up and down, based on Tesla's stock price. This is not net worth. This is just income to him from one thing, his fund, one business, which is, it's more money than anybody else makes on earth. I mean, he's making over $100 million, I guess what, $250 million a month. So like, for example, Ken Griffin, he bid on the Constitution, one of the original documents of the Constitution, and he was outbidding everybody. It was something like they paid he ended up winning the bid at around, I think it was $45 million roughly. Don't quote me on that, but roughly $45 million. And everyone's like, wow, I can't believe Ken Griffin paid all this money. Oh my gosh, blah, 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 blah. Ken Griffin makes $45 million working Monday and Tuesday and Wednesday of this week. He'll make roughly, maybe by Thursday, he's made $45 million. I mean, it's half of a work week for the guy. Every work week it's coming in. Like it's stupid how much money can be made in the fund space. So again, to summarize, that's how fund managers make money: management fees and performance fees. Now, what's unique about fund managers is years ago, the IRS wanted to incentivize fund managers to run funds. So with the tax code, by the way, the IRS for 100 years has used tax incentives to incentivize people to do certain things, to have children, to invest in green energy or oil and gas, whatever the thing is. The IRS has done things that they know will incentivize people to move money. A great example was opportunity zones. During Donald Trump's presidency, they opened up opportunity zones, and over $100 billion, flowed into low-income inner city areas in the United States, the most investment ever, because what they said was if you invest in these spaces, you get a huge tax incentive for doing so. They've done the same thing with funds. So if you run an investment fund, the performance fees you get that are paid to the general partner, you actually get taxed at capital gains rates or near around capital gains rates. And actually, back to Donald Trump, they actually raised it from 20% to 25% during Trump's era. That's why people always complain, like these fund managers are making all this money and they pay little taxes. Well, the IRS has incentivized fund managers, people like me and you, to go take the risk, to go launch funds. And by doing so, we're going to pay a lower tax bracket on that income than other people. Whether you like it or hate it, you can decide that. For me, I try to follow and copy what wealthy people are doing, and wealthy people run funds and they pay a little bit out on taxes. Additionally, a lot of these funds, on the notion of taxes, you actually can depreciate the assets. So people like Mitt Romney or Donald Trump, two politicians that formerly ran funds, they were like, you're paying like an 8% effective tax rate or a 12% effective tax rate because they owned a lot of real estate in their funds, and their real estate would depreciate, and they were an investor in those funds. And because of depreciation, that depreciation gets passed on to their investors. Additionally, as fund managers, they get a tax discount for running funds. So again, like it or hate it, you can complain to your politicians, but that's how the tax code is written. They incentivize us, people like me and you, to take the risk, to pool and aggregate capital from overseas, other countries, to invest in America. And by taking that risk and doing that, the IRS has incentivized us to run funds.